John Normand is joining us. He's JP Morgan head of cross-asset fundamental strategy. John, in your note to us, you said one of the main questions that you're getting from clients is, what's the path for inflation? We got a little bit of the answer this morning, at least for right now. The path is kind of sideways, right, or stable, I guess you could say. The question is what's going to continue to happen in the forward months. And we heard earlier from our Brian Chung about base effects and that we're going to start to see larger prints. Is that already baked in, though? Do you expect shocks when it comes to some of these inflation readings?
I think they're going to be small shocks. I think one of the lessons of history is that when inflation starts to rise, usually forecasters are just too conservative about the levels that inflation reaches. So even though there's an expectation that it will go up, I don't think those expectations are quite high enough. So my guess is we're going to see some more instability out of the bond market over the next 3 or 4 months as the economy reopens, as service activity normalizes, as we start to get more inflation out of the service side of the U.S. economy. And that volatility in the bond market is going to drive some overall volatility in other asset markets. Nothing that really ends the rally. It's just something that makes the climb a little more difficult over the spring months.
John, what level rates do you think would need to happen before the U.S. economy is harmed?
Oh, gosh, I think you'd have to see at least something around 2.5%, 3% on 10-year rates. I think that gives an immediate hit mostly to interest rate sensitive sectors like housing. But frankly, just given the amount of fiscal stimulus, which has already been given to the economy, which is going to be given to the economy through the package that will be approved this week, through the infrastructure bill that's probably going to follow that. I really don't think old benchmarks around interest rate sensitivity are going to be so relevant anymore. I think we're kind of going to move into uncharted waters where we see an economy that's quite resilient, even in the face of higher rates. It's essentially because of all the income transfer that's been happening, and that is going to continue for quite a while.
All right, now we see the opening bell on this Wednesday morning. Roblox ringing the bell down on the floor of the New York Stock Exchange. The company set to make its debut through a direct listing later on this morning. Expecting the first trade, if we go by past experiences, probably right around 11 or 12 o'clock, right towards the lunch hour. Right, John, something I wanted to ask you about is the role of retail in this market and how you guys are thinking about that specifically. Obviously, it's been a big story over the last year. A lot of questions on how durable it remains as we go forward here. What are you guys making of that, and how much on that are you getting from your institutional and your hedge fund clients?
So there are a lot of questions about the role of retail simply because we observe that they seem to be very big players in particular names, in particular sectors over sort of intra-week, intra-month period. But our general view is that retail is not the bigger driver of flows on a medium-term basis. That's more the institutional client base. And because of that, we see this as something which is really driving, kind of short-term volatility. It's not something that really is important for calling the overall direction of the market. If we started to see that retail activity was very large relative to institutional, that would be a different question, but that's not really what the numbers are suggesting.
John, you've written recently, U.S. inflation readings this spring will present a key test of market stability. What do you think the market would need to see just in terms of inflation readings for stocks to get just to come under more pressure?
Well, I think if you see a multi-month period of core inflation above 2, this is going to make some people think that the Fed has achieved its inflation overshoot, and the Fed needs to taper quickly, and then it needs to tighten maybe as soon as end of 2022 or 23. So I think just achieving that overshoot for a brief period of time will cause some confusion. At the end of the day, I think the Fed's view on this is correct, that any overshoot in the spring is going to be extremely transitory, that inflation is going to move back below 2 on a core basis sometime this summer. And therefore, there's no reason to move quickly with respect to the tightening. But I think those first few months when inflation is over 2 on a core basis is going to strike some people as putting the Fed in a difficult position.
They'll just have to wait, I guess, regardless. John Normand, JP Morgan, head of cross-asset fundamental strategy. Thank you so much, John. Appreciate it.